Greetings, it is time for another CrashWatch video because there is a lot going on in the market and a lot of complicated forces that are intertwining at once. And a video like this one is useful for people trying to make short-term decisions immediately after this video is produced. But it's also going to be useful in the months and years that follow because certain patterns that I'm going to outline in this video do tend to repeat themselves, and there are certain fundamental learnings that can continue to be had. So this is not only for the short term, these videos have some element of an evergreen nature to them. So like I spoke about in earlier CrashWatch videos, the oil price is spiking up a lot, and this is a very artificial thing. In the United States, the Biden administration has chosen to discourage and obstruct domestic oil and natural gas production, and this is for ideological reasons. This is not a good thing for the US economy because the fracking revolution was the best thing to happen to the US economy in the last 10 years. And obstructing this for ideological reasons is definitely not good for the US economy, and Republicans are culpable in this too because they don't do much to explain why this is the cause of the economic problems we're having. And then when oil prices rise, a petro dictatorship like Russia becomes emboldened and then can start invasions and other things they weren't otherwise going to do. The last time Russia invaded and annexed a piece of Ukraine, that was 2014, when oil prices were just as high as they are now. For 8 years, Vladimir Putin did not do anything because Russia's economy is very weak on account of oil being just $50 a barrel. But now with oil higher, he is becoming bolder again. So this is what is happening in the stock market. We have the S&P 500, SPY, in this dark blue line, and oil, USO, in this light blue line, and this is an ETF of oil futures that rolls over for each month of futures as each preceding month expires. Whether the futures are in a rising pattern, which is known as contango, or a falling pattern, which is known as backwardation, is accounted for in the monthly roll. We'll talk about that in some future video. But oil, as we know, has risen a lot, and oil has jumped up from what was a stable price in the 50s until relatively recently into over $100 a barrel. The stoppage of fracking caused this gradual creep upwards, which then emboldened Mr. Putin, and then he proceeded with his invasion, which caused this spike and the volatility that we see over here. Now, normally an oil spike like this is something that causes a stock market crash after enough time elapses, and I'll talk about that in a minute. But previously, oil is usually a very good hedge for the stock market because it falls much more than the stock market during a correction, but doesn't rise as fast. So for that, I go to a 5-year chart. See this correction in the S&P 500, which isn't very severe, but oil fell much more. Therefore, if you were short oil and long the S&P 500, oil was an excellent hedge. Also, during the COVID-19 correction, the stock market fell this much, but oil fell this much. Oil was a fantastic hedge if you were short. So most of the time, being short oil is a very good hedge for the S&P 500. But this time it is not, because oil is itself the leading entity, not the reacting entity. The oil price increase, due to Russia being one of the largest oil exporters in the world, is why we're having this situation right now. And despite the stock market dipping downwards somewhat, we don't see oil falling. We actually see oil rising because the forces driving oil upwards are more powerful than the pressure that a declining stock market might exert on oil. And that's what makes this situation relatively similar to what happened from 2007 to 2009, because that is when oil actually rose and the stock market did not fall in tandem with the oil until the oil rose so much that the stock market fell a lot. So let's look at a chart from that period. This is a chart from mid-2007 until the end of 2009. And light blue again is USO, oil, and SPY, the S&P 500. So oil kept rising, 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 and rising, all the way up to what at that time was a record high, $147 a barrel, which it's still not at right now. And because oil was rising so much, it caused a tremendous amount of pressure on the trade deficit of all oil importing countries, on consumer spending and consumer confidence. People saw gasoline getting more and more expensive. This negatively affected their confidence. So then oil started to fall, and then the stock market was taken down with it. And this was the big stock market crash of late 2008. You can see that the stock market fell about 50% from mid-2007 to the end of 2008. And oil had risen about 150% before falling maybe 90% from that point until oil was also a net negative. So oil rising without the stock market following suit and rising against a gently declining stock market is something that is very analogous between 2007-08 and today. Think about the implications of that. Oil has to rise to such a point, and the high cost of oil has to percolate through the entire system to the extent that consumer confidence gets low, inflation gets higher than people would like, the Federal Reserve then tightens in reaction, and there's a big crash and all kinds of dislocation and disruption and a lot of stress in people's lives. All of this was not necessary. Like I said, every finding of my research is contingent on one thing, which is that the government cannot screw things up too badly. Things were going just fine until the Biden administration came in and began to discourage domestic oil production, causing the oil price to rise, strengthening a dictatorship like Russia as well as other places like Iran and so forth. Russia invades Ukraine, oil prices rise further, and that is going to cause a market crash as well as make it harder for the U.S. economy to absorb the quantitative easing that the Federal Reserve does. Since the Federal Reserve doesn't understand this, they are going to tighten. And this is not a partisan thing either. Republicans are equally culpable for this because they did not do enough to make the case about how the best thing to happen in the last decade for the U.S. economy and for even the world economy was U.S. domestic oil production through hydraulic fracturing. Every oil importing country had a major benefit because of that, because the cost of their imports became half. Many countries went from trade deficit to trade surplus, and all sorts of unsavory regimes were greatly diminished in power, and now those regimes are becoming stronger again. Some of the blame also lies with the Federal Reserve. No one at the Federal Reserve, despite having the pulpit that they have and the platform of media attention that they have, the chairman of the Federal Reserve or even any one of the other governors could simply say that all domestic inflation is simply because of a decrease in domestic oil and natural gas production. If oil and natural gas production resumes, then whatever temporary inflation that we're seeing will also go away, and that's the truth. However, they don't come out and say that for whatever reason. Either they don't understand it or they don't want to run afoul of some other political agenda, which is part of the problem because our system then has a major weakness. People who are supposed to be only aligned with the economy, the Federal Reserve, are deliberately not saying common sense things that are obvious because the political dimension is something they cannot risk getting involved in. And when politics pervades everything, then even non-political institutions cannot normally function. The Federal Reserve should have been able to say that a decrease in domestic oil and natural gas production is the entire reason for domestic inflation and oil and natural gas price increases. That is all they had to do. But now that we see we are getting into a 2007-2008 situation again. Oil is rising higher and higher despite the stock market not rising. And normally oil would decline as the stock market starts to decline. But now oil can only decline substantially when there's a major stock market crash that pulls the whole thing down. And the probability of that happening in the near future is rising because now this is another bearish factor piled on to everything else. The Federal Reserve is tightening. They're tightening because of inflation, but the oil price increase contributes more inflation, and therefore a number of things are working against the stock market as we speak. It's going to be volatile times ahead, and things could get ugly sooner than people think. But that is what I wanted to elucidate in this video and perhaps teach you how to think about these things and how unusual this situation is. Not since 2007, 2008 did we have a situation where a large oil price increase was met with a declining stock market, indicating that the oil price is not really going to go down until the stock market declines much further and forces it down with much more brute force effect. So some food for thought for sure. If you like this type of content and find these types of videos to be informative and of practical use for you, I encourage you to upload this video and subscribe to this channel. Thank you very much for watching.